All right, and we are live. Welcome to another live stream, everybody. Do me a favor, put a 1 in the chat if you can hear me loud and clear. And we've got to talk about this forecast from the head of JP Morgan's North American Fixed Income Strategy Division. This is from the 12th of January, and this is regarding the Federal Reserve's program of quantitative tightening, the selling down of their U.S. treasuries, and the potential return, if you ask me, I mean, JP Morgan's not saying this, but a return to QE. This is going to be very important for the markets, for the price of silver, for the price of gold. And this is something which I think when markets get wind of it, when the Federal Reserve makes this official, if they do, this could really light a fire under the silver price. So what's going on here? Well, this note that was released says, we now expect that the FOMC will have the outline of a timeline at the January meeting communicated mid-February minutes to that meeting. We expect that this plan will be formally agreed to at the mid-March meeting and will be implemented beginning in April. And what this is, they're talking about the Fed outlining the end of their program of quantitative tightening. A little premature, if you ask me. They still got something like north of $7.5 trillion on their balance sheet, but they're going to have to end QT, and we're going to talk about the reasons why and why I think they're probably going to have to return to QE. It's very interesting that we're beginning to hear this now from the likes of JP Morgan. So first of all, just take a look at the gold chart here. You can see the precious metals, gold and silver, both looking very good on their charts. I mean, they're not getting a lot of love right now. It seems like sentiment towards the metals is low, but gold still hanging tough above $2,000. I think that $2,000 is the new support for gold. Silver chart, not quite as pretty, but a strong cup and handle formation. So these markets, I mean, these metals, if you ask me, are looking for a catalyst to break out of these long-term patterns that they're in. And if you want another indication that sentiment is at a low among investors in the precious metal sectors, look at what's happening to premiums. Look at the price of a U.S. Silver Eagle now. This is a sale SD Bullion is having, one I'm thinking of taking advantage of. They now have 2024 Silver Eagles back on sale for over just $3.99 over spot. That is a huge diminishment in premiums on U.S. Silver Eagles since March of 2023, at a time in which the premiums on Eagles were almost double the spot price of silver, now $4 over. So that's an indication. It's not that, people buying physical silver are necessarily setting the price of silver. That's not what the spot price is determined by. It's determined in the futures markets. But the fact that this demand for physical silver products has come down to the point that premiums are so low, I think at least is an indicator that sentiment for the metals is incredibly low right now. And that's why I'm still considering buying. I mean, yeah, gold is near all-time record highs. I think it's going to be going to much higher records, but silver still incredibly cheap. And it's a sector that is just completely unloved. One of the few sectors where that is the case. But look, it's not just JP Morgan who is telling us that the Fed may be ending quantitative tightening. This is a piece published today in the Wall Street Journal, written by Nick Timiraos. This guy is the Fed whisperer. You might have heard him referred to as. There is some speculation. Maybe he has inside information from the Federal Reserve. He seems to have some pretty good insights into what they are doing. And he tells us that Fed tiptoes towards dialing back key channel of monetary tightening. He's talking about slowing down the pace of QT. But that is just one step on the way to further quantitative easing, further debt purchases, further debt monetization by the central bank. We'll talk about why here in just a moment, but let's hear what Nick has to say. So Nick tells us, the Fed whisperer here, he tells us, though the Federal Reserve stopped raising interest rates last summer, it's quietly tightening monetary policy through another channel, shrinking its $7.7 trillion holdings of bonds and other assets by around $80 billion a month. Now, they've been doing this for a while, but he says now that too may change. Fed officials are to start deliberations on slowing, though not ending, the so-called quantitative tightening as soon as their policy meeting this month. So if they do this, if the Fed tells us at the January meeting that quantitative tightening is on its way out, I think that could be in and of itself a catalyst to send the metals much higher. He says its rationale for tapering bond runoff is different from its rationale for cutting interest rates. That is to prevent disruption to an obscure yet critical corner of the financial markets. Now, we talked about this in a recent live stream that over the holidays there in December, we had this Soar rate, the U.S. overnight funding rate. This is one of these repo agreement overnight swaps. Basically, it was a signal that there was a lack of collateral in the system. But the point is that, we've got this debt-addicted economy. It needs constant influx of liquidity, and that's not being provided by the higher interest rates that the Fed has set. Things are starting to break. We see that in this overnight rate soaring to a record high since the number, this so forth thing's only been around since 2018. It replaced Libor, which, there was that whole scandal surrounding. But so forth began in 2018. The highest interest rate on so forth on record occurred in December. It's just one sign of this problem that is being brought on by the Fed's balance sheet. Now you can see this is the chart here of the Federal Reserve asset holdings in this piece by the Wall Street Journal. Yeah, they've managed to come down to about $7.7 trillion. Of course, they've barely unwound any of the stimulus that they did initially there in 2020, the pandemic stimulus, where the Fed balance sheet grew from $3.76 trillion all the way up to $7 trillion. I mean, we're still above that. We're at 7.6. So they can barely get the balance sheet down to the end of the pandemic stimulus, and things are already starting to break. So yeah, this is a sign that not only will the Fed have to end QT, they're going to have to go back to QE. And again, we'll get into some more reasons why as we go through this, but let's talk about what the QT here from the Fed Whisperer, the tapering of the tightening. He says a bank uses reserves to manage transactions between itself, its customers, other banks, and the central bank. The Fed and private sector forecasters thought banks had far more than needed for this, but in September of 2019, a sharp, unexpected spike in overnight lending rates suggested reserves had dwindled to the point that they were either too scarce or difficult to redistribute across the financial system. Now, the Fed was buying Treasury bills in response to this back in 2019. And you can see that this was, where they were tapering back in, I think starting in like 2015. They started to kind of draw down the Fed balance sheet from the great financial crisis stimulus. And here, this is pre-COVID, pre-pandemic, September of 2019. They actually had to come back in and start buying up bonds. This is nothing to do with the pandemic, but simply the fact that they had broken the system via they're tapering that time around. Well, now we may be arriving at that same point, and that's why I think they're going to have to not only end QT, but they're going to have to get in here and buy more bonds, just like they did in 2019. Policymakers have several reasons to consider slowing the runoff. First, the Fed is shrinking its Treasury holdings by $60 billion a month, twice as fast as it did 5 years ago. Now, I'm going to interject here that on a percentage basis, though, I think it's probably about the same because the Fed's balance sheet is so much bigger right now. But then he says here, continuing to run at this rate raises the risk that the Fed drains reserves so quickly that money market rates jump as banks struggle to redistribute a dwindling supply of reserves. So spiking interest rates are going to cause the Fed to get in here and create some more money and initially slow down their pace of tapering or tightening. See a lot of likes in the channel. Thanks to everybody who's watching. Do smash that like button. This is important. The return to QE is going to be, I think, the thing that potentially kicks off a massive devaluation in the dollar, as well as a big increase in the price of silver. So the fact that you've got mainstream voices such as Nick Timiraos, such as JP Morgan, now talking about an end to QT, which, so up until this point, Federal Reserve really hasn't commented on too much. I mean, back in the press conference for the last FOMC meeting, Powell was I think he said that they weren't even thinking about ending QT. I think that was what he said. Of course, now at this next meeting, they're going to outline the timetable for it. So it gives you an idea of what you can take away from, the Fed's talking points here. And I think I mentioned that on a live stream. So any of you who have been watching this, you've probably seen this coming. But it goes on to say here, second, there are signs that the cash surplus in money markets is rapidly diminishing. The Fed allows money market firms and many others to park extra cash that would otherwise end up in reserves in an overnight reverse repurchase facility. The facility has shrunk by around $1 trillion since late August to around $680 billion. Logan endorsed slowing runoff once that facility is nearly drained of cash because after that, forecasting demand for bank reserves will be more uncertain. So basically, this thing is ticking down, this overnight reverse repurchase facility. And when it hits zero, they're going to have to do something. I think it's going to take more than just ending quantitative tightening. But this article is interesting. I mean, I would recommend you check it out, read all the details. Now, if you want to look for signs that the Fed is going to have to get back into the market and begin QE again, you don't just have to take JP Morgan's word for it or Nick Timmerhouse. You can just look at things like this, the Bank Term Funding Program. Now, we just got some new data from this, and surprise, surprise, on January 10th, this is our most recent data, we once again hit an all-time high in this emergency lending facility that is being utilized by small regional banks to put up devalued U.S. Treasuries as collateral for loans from the Federal Reserve. They're getting those loans at par, by the way, so significantly more than the bonds are worth, the ones that they're putting up for collateral. This is already QE, just by another name, basically. But this facility is set to expire in March. Now, unless those treasuries gain back some value, I don't know that it's going to help the banks much to take them back. They're going to get their collateral back and pay the loan back? They can't pay the loan back because the reason they needed the loans in the first place was to avoid selling those assets to satisfy withdrawals, deposit withdrawals. So unless a bunch of people come and, deposit their money back in these small regional banks, which I don't really see happening, this is going to have to be extended. It's probably going to have to be expanded rather than drawn down in March. And that's exactly what we're beginning to see from these forecasts from JP Morgan, who says that they're going to outline an end to QT as soon as the January FOMC meeting. JP Morgan says they're going to finish ending QT sometime in November of 2024. I think by November of 2024, we're already going to have seen a return to QE. The Fed is going to have to get in, buy up bonds, drive interest rates down to bail out all of these regional banks, because the thing is, the reason why the bonds that the banks are holding that are, declining in value is because the yields on treasuries have gone up. So these treasuries have a very low yield. They were all purchased during the pandemic when rates were near zero. So when yields go up, existing issues of debt decline in value. So how can the Fed bail these banks out? Well, they can get the treasury yields back down closer to zero. How do they do that? Well, they have to buy the debt. That's how they can do that. So here's another reason. I mean, we talked about this in a recent live stream, but I thought it was worth mentioning again. The U.S. budget deficit for December up 52% year over year to $129 billion. The first quarter of fiscal year 2024, which began in October, the deficit has been something north of $500 billion. You annualize that, that's more than a $2 trillion annual deficit. Someone has got to buy up all of that debt. Who's it going to be? It's not going to be China. They're dumping debt. It's not going to be Saudi Arabia. They may be dumping their debt soon too if the petrodollar system comes under pressure. So who's left? Who's going to buy up all the debt? Well, there's only one force that can buy that magnitude of treasury notes. It's the Federal Reserve. How do they do it? They print the money. What does that do? Well, it unleashes the forces of inflation. Now, I want to talk about that because this is the most recent update on the Middle East conflict. The U.S.-owned container vessel struck by an anti-ship ballistic missile off the coast of Yemen. This is from today. This is going to be the scapegoat for the inflation, which is coming, just for the record. So you can expect that when QE comes back and when inflation runs out of control, they have already got this scapegoat lined up for the inflation. That is the disruption of global supply chains. And yeah, that is a problem. It's going to amplify the inflationary forces that are unleashed by quantitative easing. But this will be the next scapegoat, guaranteed, just like in 2022, you had, Putin's price hike. Well, now you're going to have, the Yemeni price hike. That's what's coming next. The Houthi hike. That's probably what they'll call it. I'm going to call that right now. We're going to hear Biden or Powell talking about the Houthi hike. So just get ready for that, because you got to understand it's not all going to be because of this conflict. Now, the conflict will be very inflationary. One, because of supply chain disruptions. Also, ultimately, because of what it does to the national debt. nothing is better for expanding the debt like war. It's very costly. We don't have a war chest to dip into, so all the money is going to have to be borrowed, and it's all going to have to be borrowed from the Fed because, we've already got massive record deficits. So how are they going to finance this coming conflict? Well, they're going to borrow the money. They're going to have the Fed buy up all the debt, and it means that inflation is going to get a lot worse. And when investors realize what is coming, I think that there's going to be a rush to the exits. The exits are pretty small door. It's a very small physical silver market, slightly larger physical gold market, but also there's just going to be too many dollars out there. And I think it means that those who are holding hard assets are really going to be the ones who maybe they're not going to benefit from this, but they'll at least be insulated from the worst of the shocks. And I think that's about the best you can hope for given this situation. So do me a favor, smash that like button, share this video with your friends. If you haven't subscribed yet, subscribe to the channel. And get ready for what's around the corner, folks, because we might hear about more QE or the first step in that direction as early as the end of this month. Let me know what you think in the comments down below. Stay safe and happy stacking, everybody.